Good evening, everybody. Welcome to the first in my new series called Beginner to Winner. My name's Jack. I'm a fully funded Forex trader specializing in my own trading style called Strong Money Forex. I've been trading now for about 5 years and I've learned many different styles of trading. My methods are similar to some smart money or institutional concepts is the buzzword, but with less fluff, less technicals, and a more common sense approach to taking trades. So a simpler understanding of how it all works. My method's really, really simple. Where is the strong money? Which direction is the strong money flowing in, and how can we get involved? In this series, the aim is to give you a fully tradable strategy, how to make trades, how to make money, how to make profit, and ultimately take your trading to the next level. Whether you're a complete beginner or you're at an intermediate level, wherever you are, really, hopefully you can learn something from this. And by the end of this, we are going to have a clear trading strategy that we can use to pass a prop firm challenge. We're then going to use the strategy to pass a prop firm challenge verification and ultimately get our first payout. We've been trading Forex for a while. You probably know how difficult it can be. And what I'm planning to do here is give you a clear structure and a clear set of rules to follow that will take you from your beginner level, intermediate level, or whether you're consistent or nearly consistent or losing consistently. By the end of this series, you will be able to take winning trades more often than losing trades, and ultimately make yourself some money. So if you like the sound of this, please do me a huge favor, click the like button and the subscribe. It takes you less than a second, costs you nothing, and helps me massively with my channel. You probably know that the market moves up and down. You see these kind of candles and price goes from kind of highs to lows, lows to highs. You've got three types of market structure. You've got uptrends, okay, pretty simple. High to a low, to a higher high, to a higher low, to a higher high, to a higher low. This pattern is an uptrend, and this is where we'd be looking ultimately for buys, okay? We then have ranging markets, which I'm not too fussed about getting involved with, but this is where we don't really get kind of new highs, new lows until it breaks one way or the other. You can often draw a straight line from one way to another on these trends. I mean, this isn't a great example, admittedly, but just for simplicity's purposes, you can kind of see where we're going here. This is kind of here, flat line kind of. So this is kind of a ranging market. You can still make some money here, but it's not the best market conditions, admittedly. Okay, and then we've got our downtrends, which are pretty clear. Okay, so we've got high to low, to lower high, to lower low, to lower high, to lower low. And this consistent break of these lows here tells us we're in a downtrend. Equally, if we're in an uptrend, it's the consistent break of the highs here that tell us that we're in an uptrend, okay? So we're looking for these kind of market conditions, and this is where ultimately we will have an indication of where price is going to go. In a downtrend like this, we assume, because we've had this low broken here, we assume that the likelihood is that the market is going to continue down, and more often than not that it does, okay? Now I have a rule that you always trade the trend until the market clearly tells you it's going the other way. So again, as a good example here, we're in an uptrend. Okay, we're making higher highs, higher lows, higher highs, higher lows. We get stagnant here, and then we break down. Okay, we break this low. Now this is a clear indication that the market is now moving down. The structure has changed. This line here has shown us that we are now in a downtrend. We've broken that line, and ultimately we are now in a downtrend, okay? So you trade the trend until the trend clearly shows you it's going in the other direction. So that's our kind of basic structures and trends. Now, how we use these is through what's called multi-time frame analysis. So I'll show you what I mean. Okay, in an uptrend, we have a low to a high, to a higher low, to a higher high, to a higher low, to a higher high, okay? And it's these consistent breaks here of these highs that tell us we are in an uptrend, okay? Each time we break one of these highs, we're in an uptrend. Now, you can very simply just trade these. You could put your stop below this low here. You could enter somewhere here, and you could target this high with the expectation. And look, you got a 1.9, nearly a 2-to-1 trade there. Not a bad trading strategy, but we can use these multi-time frame analysis methods to help us get into higher profitable and better trades ultimately. Okay, now what normally happens is within these higher time frame trends, we have lower time frame trends. Okay, markets are often fractal, which means what happens on the higher time frames happen on the lower time frames. Okay, and we get these lower time frame trends here. You can get the gist that when we drop down time frames, okay, we have the same kind of structural points here. So we've got higher high broken, higher high broken, higher high broken. Okay, you can see here we're getting these highs broken, we're in an uptrend. And then what you can do with these is you can get tighter entries. So now, same trade we took earlier, which was a 2-to-1, is now a 3-to-1 or a 4-to-1. So using the lower time frame trends, we can get into tighter trades and ultimately get better entries. And this is how we get our better trades. You can make profit from using this pink line here and using that trend. But by zooming down into lower time frames and using a lower time frame trend, you can get into even better entries. And you can also get into multiple entries as well. With this higher time frame trend here, this pink line, you had one trade. With this lower time frame trend, you had one here. You could keep adding into them over and over and over again. One there, one there, one there, one there. So now you've got, let's say, all of them you took up to here. Not only have you got into 4 high probable trades, you've got a 4-to-1, 3-to-1, 3-to-1, 2-to-1. So what's that? 4, 7, 8, 9, 10, 11, 12. So you've got a 12-to-1 now from the same trade that previously would have been 2-to-1. So you can see how powerful this can be. You've gone from taking one big trade here, which would have had a massive stop on it as well. I personally, I don't like taking a trade with a 335 pip stop. Okay. That same trade here, even if you'd got a really nice tight entry down here, for example, you've got a 4-to-1 here. You've got 4 trades, independent trades, confirmed trade as well. Because each time these highs here, look, each time these highs here break, okay, each time you get this new break of the higher high, this is confirming that the uptrend is in full effect. So these become higher probability each time they go up and up and up. So 1, 2, 3, 4 trades at 12-to-1. Or 12R total compared to one trade at 4-to-1. If that trade lost, you're out. Whereas you might get, say, 1 loss down here, but then you get 3 wins. So you can see you're stacking the odds in your favor. You're taking more high probable trades, you're taking less risk, and you're ultimately getting more profits out of it. So this is how we use multi-time frame analysis. And you could go down even further. You could zoom into these lower trends here. Look, for example, you could zoom right in here. And within here, you would have, again, the same thing. You'd have smaller trends, same thing happening over and over again. So price is fractal. What happens on the higher time frames happens on the lower time frames over and over and over and over again. Okay, I'm just going to leave that there just as an example. Let's change that to blue. So again, same thing applies. You could take these trades here. Now you've got a really nice tight, well, that's not even tight itself, 44 pip stop, but look, you get the gist, okay? Now we get into one little trade here, okay, where we've got our 4 trades there, and we've got our 12-to-1. You can get into multiple trades here. You've got one trade as a 22-to-1. So you can see how you can use it. That you get, the higher time frames, they're more reliable. Of course, this is a more reliable trade, okay? This is slightly less reliable. This is slightly less reliable, but you've got more opportunities, and you can keep dropping down onto time frames. And this is how you ultimately get into, the really nice tight trades. So we use multi-time frame analysis. And this is what allows us to get into the high probability trades. We stack confluences on our side. As the first part of the market structure video, I hope you learned something in this. I hope you picked up some clarity on the reasons why we follow market structure, the reason why it's so important, and how to use it in your trading to not only get into better quality trades, but high probability trades, and also make money off those trades that you're taking as well, or larger return. We'll discuss in more detail how we utilize these things, and there'll be a second part to the market structure video coming really soon. I'm going to try and get a video out to you guys maybe once a week or so. At the moment, I'm still working full time, as well as doing my trading, everything else that comes with it. So I'll do my very best to get content out as quickly as I can. But to help me to do so, massive favor I would ask, if you can like below, click the subscribe button, and of course put the notification bell on, especially if you'd like to see the next part to this series. You can be notified when the next video lands. So again, thank you for joining. Thank you for sticking with me. And any questions, please put them in the comments below, and I'll answer everyone.